Friends, welcome back to our channel Om Sai Bhojanapalli.
Good morning, friends. So in the previous class, we are doing the area dealer's desk in the international financial management, where we completed two problems relating to exchange position versus cash position. One problem, it's an examination problem asked in two attempts. This particular question, that is a covered deal calculation, profit or loss. A very simple question only involving cross rates also will complete it. Then we will be doing the bits and pieces problem here and there left out. I think in between we had an interest rate parity problem, missing figures calculation not done. We had one money market hedge problem with taxation which is not yet covered. Like that we have currency arbitrage, one problem to be done, and then miscellaneous will be having one or two sums to be covered. So all this will just try the loose ends in today's class, cover those problems, and then we can just move on to the next chapter, namely bond valuation, which speaks about another market called as fixed income securities or a bond market. But bond valuation chapter, before I start, I will just do in a very brief way one IPCC chapter called as time value of money. I think all remember the chapter or not? No. So you may be aware of it or not aware. I don't want to take any chance because time value of money will be playing a very crucial role in mainly bond calculations like yield to maturity calculations, even in share valuation, all valuation concepts. This time value of money one should be very much thorough. We should understand in what sense I am speaking various calculations. Hence we will be spending 1 to 1.5 hours time and discuss about the time value of money. That is going to be the basis for all the remaining chapters to follow. In this chapter we did not have so much use in the time value of money, but the chapters to follow will be using it very regularly and frequently. We'll summarize that particular time value of money introduction, and then we can just start with the bond valuation chapter. Another 3 or 4 classes will be discussing about the concept called as bonds or fixed income securities. Now let us summarize what has been discussed in this chapter till now. We saw that companies which are engaged in cross-border trade, investment, financing, etc. are exposed to a specific type of risk called as currency risk. This risk arises due to the exchange rate fluctuations. The strategies they adopt to protect against themselves from the currency risk is called as hedging strategies. The famous hedging strategies are forward hedging, money market hedging, leading, lagging, netting, currency options, currency futures and currency swaps. And apart from the hedging strategies, we also will be learning arbitrage strategies, where a person can see the imperfection in the market pricing, jump into it to make a riskless profit, which we call as arbitrage process. There we will discuss two areas, namely covered interest arbitrage and currency arbitrage. Finally, we said that we will be discussing a portion called as dealer's desk. First, we completed discussing the basics in forex, direct quote and indirect quote. 1 unit of foreign currency in so many units of home currency is called as direct quote. 1 unit of home currency in so many units of foreign currency is called as indirect quote. 1 by direct is equal to indirect and vice versa. Bid rate is the buying rate of the banker, offer rate is the selling rate of the banker. Customer sells at bid rate, customer buys at offer rate. The difference between bid and offer is called as spread. Spread can be expressed as percentage. What is percentage spread? Spread divided by offer rate into 100 or spread divided by bid rate into 100. Then when you have a two-way quote, the bid rate of an indirect quote is equal to 1 by offer rate of a direct quote. Offer rate of an indirect quote is equal to 1 by bid rate of a direct quote. When you don't have exchange rate between two currencies, use a common currency to find out them. It is called as cross rates calculation. Then we discuss forward hedging basics. Forward rate is a rate decided today for a transaction to take place tomorrow. For a currency, forward can be quoted at premium or discount. Forward rate more, it is premium. Forward rate less, it is discount. Forward can be given straight away, called as outright forward, or they can give swap points along with the spot rate. The swap points can be ascending, descending. Ascending swap points are premium, should be added to spot. Descending swap points are discount, should be reduced from spot rate. Forward or say premium or discount can be expressed as annualized percentage, that is forward rate minus spot rate divided by spot rate into 100. Then into 12 by n. Okay, accept into 12 by n. Then we discuss about the forward rate determination. Theoretically, a spot rate taken to the future date using inflation rates of two countries we call as purchasing power parity forward, or the spot rate taken to the future rate using the interest rates of two countries we call as interest rate parity forward. When IRPT is present, covered interest arbitrage is absent. When IRPT is absent, covered interest arbitrage is present. So covered interest arbitrage means there are two markets, money market, currency market. Country having a low interest rate will be compensated by having a premium on its currency value. Country having a high interest rate will suffer a disadvantage of having a discount on its currency value. If you want to make profit from the interest market or money market, you will make a loss in the currency market, and vice versa. This profit and loss will be exactly offsetting each other at the interest rate parity forward. If IRPT is absent, profit one way will be more than the loss in the other market. In that case, through a strategy, one can make a profit, that is called as covered interest arbitrage. 4 steps for a single quote: identify the currency, calculate forward premium or discount, compare the local interest rate with adjusted foreign interest rate, which is nothing but foreign interest rate plus or minus premium or discount. And 4th step is action, which is borrow, convert, invest, realize, reconvert, repay borrowing, book margin. You can also do the same from the currency market angle also. Identify the currency. Instead of calculating premium or discount, calculate the IRPT forward. Step 3, compare the actual forward with the IRPT forward and see whether the currency is overpriced or underpriced. Accordingly, decide where to borrow and invest. In two-way quote, 3 factors plays a role apart from the interest rate difference as well as the forward premium or discount. Spread also plays an important role. In that case, we straight away go to the action step to find out whether profit exists or doesn't exist. Then we discuss about money market hedge. It's an alternative to forward hedging, where when you have we discuss about money market hedge for payable exposure, receivable exposure, with deposit and lending rate, bid rate and offer rate, with euro rates as well as what? Domestic rates. Euro rate is a rate at which a non-resident can access a foreign currency, and domestic rate is a rate at which a resident can access his home currency, is the meaning. In that case, when I have a foreign currency payable, I have a payable exposure, I have to pay $1 lakh after 1 year. Today what I should do in the dollar market? Deposit. Where I deposit? Euro dollar deposit. I should deposit the present value of the exposure. To deposit, I should borrow the local currency, convert at the spot offer rate and then deposit. The local currency borrowed should be repaid along with the interest. The compounding interest being domestic rupee lending rate. Similarly, money market hedge receivable. I have receivable of $1 lakh. Again, the receivable today I am going to borrow. I borrow present value of $1 lakh. How much to borrow? What is the discount rate to be used? Euro dollar lending rate. The amount borrowed should be converted into rupees using what rate? Spot bid rate. The rupees should be deposited locally and realized with maturity. In that case, what should be the compounding interest rate? Domestic rupee deposit rate should be used. Instead of myself depositing or borrowing in the foreign currency, I can ask my supplier or customer to deposit or borrow, and then the discount can be availed or can be given. That strategy we call as what? Leading. Leading may be better if the euro rates and domestic rates has got an advantage. Then we discuss about lagging. Lagging means I have to pay today, but I can pay tomorrow using the forward cover. If the forward is cheaper than the bank OD interest rate, I can rather go for lagging instead of making a spot payment. Then we discuss about exposure netting. Netting means we use a foreign currency receivable to net off the foreign currency payable. Unnetted exposure only should be hedged. How to tackle a timing difference and netting has been done in that Woolworth limited problem in the workbook. Once the netting is completed, we discuss about the forward disposal. Forward can be honored, forward can be dishonored. It can be honored on due date or can be extended. It can be dishonored on due date or can be dishonored before the due date. In case of preponement, the preponement can happen yearly or on the date of requirement. Extension can happen yearly or on the due date. Cancellation can happen yearly or can happen on the due date. All this can happen for a receivable person as well as a payable person. Hence we discussed 12 problems in the previous 2 classes regarding this forward disposal. Then we discuss now about the dealer's desk. We saw the discussion in 3 stages. Namely, a dealer will try to first hedge his risk. When you sell foreign currency to a banker, he'll find another buyer and then he's going to transfer it. Otherwise, he'll be having an exchange risk. In a given period, he may end up with a overbought or oversold position, which he goes to the international currency market and then buys it or sells it to cover his position. Such a transaction we call as covered deal. In the covered deal, he is a banker or a customer. When he accesses the international currency market, he becomes a customer in that particular case. Next, when you give foreign currency, the banker will deposit in an account, foreign currency account. When you buy foreign currency, he will withdraw from that account and give you. That account we call it as nostro account. Nostro account is a foreign currency account maintained by a bank with another bank for which that currency is a home currency. And we saw that cash position is buy and sell and nostro account is debit and credit. The nostro account balance should not be too large because it is a non-interest earning account. It should not be negative because on OD interest will be charged. So they always try to manage the exchange position and cash position by fixing target balances and doing the respective transactions. How that happened we have discussed in the previous class through 2 sums. Everybody respond. Are you following or not? Now, for this I should give you notes now. What I will do is, I will give you the typed notes because I have already completed 2 problems. You should be now aware of it. Next class, 1 or 2 sums which I give as homework, I will be giving you the solution. With that solution, I will be giving you the printed notes for this particular cash position versus exchange position. So that's a big notes to be written on. We need not waste time on that. That alone I'll be giving you in the next class. We'll complete 1 more problem in the cover deal and then go for the miscellaneous area here and there to complete it. Okay. Now take question number 44. Take question number 44. Dealer's profit. The better heading for the problem will be covered deal. You would have been given it as covered deal. Okay. Now, you sold Hong Kong dollars 10 million value spot to your customer at 5.70 and covered in London market on the same day when the exchange rate was dollar to Hong Kong dollar, it is 7.5880, 7.5920. Local interbank market rates for US dollar were spot 42.70 and 42.85. Calculate the cover rate and ascertain the profit or loss in the transaction. Ignore brokerage. In any market, when you buy and sell, there should be a brokerage paid from the platform in which you do the trading. So in all our classroom discussion, we'll ignore the transaction cost. In a transaction cost always hides the concepts. So there is always in any books, in any works, they'll be ignoring the transaction cost. Okay. Now go through the question before I start with the solution. Let us do it together. Can I start over? Now. Who are you? That's the question. This is the question, who are you? You are the banker. Okay. Now, as a banker, the first transaction which you did today is buying or selling. We sold to our customer. What currency? Hong Kong dollar. How much? At what rate? 5.7. This has happened. Today you end up with an overbuy or oversell position. Oversell position. Normally, in case of dollars, pounds, etc., euros and all, bank will have a hope that tomorrow there will be a counter customer for them to buy and sell. And if the transaction size is very big, naturally they are going to take a position. It is 10 million, and that to what currency? Hong Kong dollar. They don't want to take any chance by keeping their position open. They want to what? Close their position. So today they are selling to you the Hong Kong dollar or not? Bank. So what the bank will do? It will go to which market? International market, and then do a cross transaction, that is going to buy it, so that the transaction gets closed immediately. They don't have the exchange position kept exposed or kept open. Everybody fine or not? Tell me, you are going to buy Hong Kong dollar or sell Hong Kong dollar? They are going to buy, because they are sold to a customer. So in the international market you have to buy the Hong Kong dollar. Respond, yes or no? Now, you buy, the banker buys at what rate? The banker buys at what rate? He will buy at offer rate, because now he is not a banker, he is also what? A customer in the international market, right or not? Normally the banker buys at bid rate. If he deals with you, yes or no? But he is going to go to the wholesale market, right or not? In that case, he is going to buy at what rate? Offer rate. So the rate which requires what rate? Offer rate. Now the question is, in the London market, is there a quotation available between Hong Kong dollar and rupees? Respond, yes or no? No. In that, we are having what? The exchange between Hong Kong dollars and dollars, and then in the local market we have the rate for what? Dollars and rupees. We should use what rate? Cross rates to establish relationship. Respond, yes or no? Now, don't think that in London currency market only pounds are traded. Not so, because in the London market it is one of the big financial markets in the world where almost all the major currencies are bought and sold. Everybody following on? So there I go to the London market to trade in what? Dollars against Hong Kong dollar. I come to our market to trade in what? Rupees. Using cross rates, I can just establish the currency relationship. Everybody, can you start or not? Now, let me discuss and then put the slide. Please tell me how to calculate cross rate. The rate I require, please tell me first what the rate I require. I want rupees to Hong Kong dollar. I want what rate? I want offer rate. Respond. Are you following or not? Now, what is the common currency? Dollar. Can you tell me the exchange rate? Rupees by dollar into dollar by Hong Kong dollar. Respond, yes or no? $1 is equal to how many rupees? Like the rate is given or not? Yes. Question apart, look at the question. In the question, have they given $1 is equal to how many rupees? Yes. In that case, for this, I am having what code? Direct code. Not an issue at all. It or not? No. Now, 1 Hong Kong dollar is equal to how many dollars I want, right or not? But in the problem, have they given quotation for Hong Kong dollar? Dollar. I want the quotation for Hong Kong dollar, but they given a quotation for what? Dollar. So what I should do? I should convert it into the other way code. So I want what rate? Offer rate. Offer rate is equal to what? 1 by bid rate. So for this, I should be using a 1 by bid rate. Should be used for conversion purpose. Am I right or not? Now, please tell me the calculation. Rupees to dollar offer rate. What offer rate of rupees dollar? 42.85. Everybody, next. What is the dollar to Hong Kong dollar? 1 by bid rate. What is 1 by bid rate? 1 by 7.5880. Now 1 by bid rate gives you the offer rate. Yes or no? If I simplify, I'll be getting the cross rate. What cross rate? 5.61. It's going to be 5.65. Right or not? Now, see, I have sold to my customer how much rupees? 5.70. I buy in the money market in the international market how much? 5.65. Still I make what? Profit. But the spread may not be as big as what I had with what customer, because with two customers I am dealing with the pure spread. But here the spread is only between the wholesale prices and then what? The retail prices. Everybody fine or not? still he can make a profit. Understand that, because he is buying in the international market where the volume is what? Very big. The margin will be very small. But when he sells to a retailer, he is selling at what? Low volumes. But the margin is what? Very big. Are you following what I am saying? So this is what has happened in this covered deal. Can I proceed further now? Let me complete, or let us do it together. Okay, please. Now, this is only to understand it. Can I proceed or not? Now. So he sells to the customers 10 million Hong Kong dollars, and the bank is buying from the London market the same. Okay, now write down rupees to Hong Kong dollar is equal to rupees to Hong Kong dollar is equal to, this is question number 44. Rupees to Hong Kong dollar is equal to rupees to dollar into dollar to Hong Kong dollar. Rupees to dollar into dollar to Hong Kong dollar. Rupees to dollar into dollar to Hong Kong dollar. Can I start or not? Now, tell me what is rupees to dollar. Tell me the number. It is 42.85. 42.85 into 1 by 7.5880. 42.85 into 1 by 7.5880 into 1 by 7.5880. Next, which is equal to 5.6470. That's what I think rounded off and said as what? 5.65. 5.6470 is equal to 5.6470. Can I proceed to the next step or not? Now, let's repeat it once again. I'll give the notes later. Gain or loss on covered deal. Gain or loss on covered deal. Gain or loss on covered deal. Sells Hong Kong dollar to customer. Sells Hong Kong dollars to customer. Sells Hong Kong dollars to customers. Tell me at what rate is sent to his customer? 5.7000. 5.7000. Next, buys Hong Kong dollar in London market. Buys Hong Kong dollar in London market. How much he buys Hong Kong dollar in London market? 5.6470. 5.6470. Does he make a gain through this covered deal or not? Yes, it is going to be gain. Gain per Hong Kong dollar. Gain per Hong Kong dollar. 0.0530. Gain per Hong Kong dollar 0.0530. He makes gain for 1 Hong Kong dollar or 10 million Hong Kong dollar. 10 million Hong Kong dollar. Gain for 10 million Hong Kong dollar. Gain for 10 million Hong Kong dollars is 10 million into 0.0530 is equal to how much? 5,30,000 rupees. Because 1 million is equal to 10 lakhs. 10 million means 100 lakhs. Into 0.0530 gives you 5,30,000 rupees. Is equal to rupees 5,30,000. Is equal to rupees 5,30,000. Can I proceed or not? No. I'll really tell how this cross rates works in the market. See, I have to buy Hong Kong dollar, right or not? In which market? London market. When I see the website, that is the buying and selling in London market, the problem is I have Hong Kong dollars bought and sold there, but it is not quoted against rupees. Are you following on? It's quoted against only what? Dollar. That means in that market, I should make payment through what? Dollars and buy the Hong Kong dollar, right or not? For that, here what I should do? I should first purchase a dollar. First I purchase a dollar in what? Our local bank market, and with the dollar I am going to London market and what? Purchase a Hong Kong dollar. Through this will be the net in outflow I am going to have in what? Rupees. Everybody, are you following not? So here I purchase a dollar at offer rate, and then what do I do? I just sell the dollar there at what rate? Bid rate. That's why I am using the bid rate here. Everybody following or not? Again I say, here I purchase a dollar at what rate? Offer rate. I go to London market, that I purchase dollar, sell the dollar, sell the dollar. At what rate here? Bid rate. That is why for Hong Kong dollar offer rate becomes what? 1 by bid rate, which is used, and then the Hong Kong dollar is there, and then I'm going to just use my position to cover it. Everybody following or not? This is what we call as a covered deal transaction. Can I proceed? Write down. Note. Write down. Note. I think, sorry, I said wrongly. I go to the London market, I sell dollars. I sell dollar at what rate? Bid rate. And I purchase a Hong Kong dollar at offer rate. Are you following or not? No. Correct, Amma? Okay, right. If you have got confused, listen here. Okay. I'm afraid. Okay, now, see, number one. I want to buy Hong Kong dollar in London market. Yes or no? Can I pay rupees and buy in London market? No. I want what? Dollars. First, what I do? In our local bank market with some other bank, I'm going to buy what? Dollars. Point number one. Right or not? What I do with that? I buy the dollar at what rate? Offer it. I take the dollar to what market? Hong Kong dollar. That is in the London market. In which I'm going to buy dollar or sell dollar. Sell dollar. I sell dollar at what rate? Bid rate for the dollar. I buy what? Hong Kong dollar. For which that 1 by bid rate becomes what? Offer rate. That's the issue. Everybody now having the clarity or not? Now, write down. Note. Point number one. The bank here is having a sell exposure. Because can be either having a overbought or oversell. Yes or no? The bank here is having a sell exposure. The bank here is having a sell exposure which it wants to cover. Which it wants to cover by purchasing. Which it wants to cover by purchasing. By purchasing what currency? Hong Kong dollar. Which it wants to cover by purchasing Hong Kong dollar in the London market. Which it wants to cover by purchasing Hong Kong dollar in London market. Which it wants to cover by purchasing Hong Kong dollar in London market. Can I proceed or not? Point number two. This transaction is called as. Point number two, this transaction is called as. When I say this transaction, already mentioned what transaction? Purchasing Hong Kong dollar. Okay. This transaction is called as what deal? Covered deal. This transaction is called as covered deal. This transaction is called as covered deal. Where the banker becomes customer in the London market. This transaction is called covered deal, where the banker becomes customer, in the London market. Where the banker becomes customer in the London market. Point number 2 or 3? 3. Since in London market, Hong Kong dollar is traded against dollar. Since in London market, Hong Kong dollar is traded against dollar, we first purchase dollar in local market. We first purchase dollar in local market at what rate? Offer rate. We first purchase dollar in local market at offer rate. Normally the bank purchases at what rate? Bid rate. But now they purchase what rate here? Offer rate. Underline that word offer rate. We first purchase the dollar in local market at offer rate and then sell the dollar in London market against Hong Kong dollar and sell the dollar in London market against Hong Kong dollar at what rate? Bid rate. Against Hong Kong dollar at bid rate. and sell dollar in London market against Hong Kong dollar at bid rate. That is how one should read the cross rate transaction. Everybody have the clarity or not? Now, with this, we have completed this concept called as covered deals. Now, take question number 14. Take question number 14. It's a very regularly asked type of problem in the examination. Currency arbitrage, very simple sum, but a very popular problem also. Okay, take question number 14. Find out arbitrage possibility from the following. Here, so from where investment should start, assume there is no transaction cost. £1 in London is rupees 55.50. $1 in Delhi is trading at rupees 35.625. £1 in New York is $1.5820. This is a question. That's all, yeah? Yes or no? Yes, see. Now, what we are going to do is, we have got three currencies. What are three currencies? Rupees, dollar, and then pound. Okay. Now, using a common currency, I am going to find out the exchange rate between the two currencies using cross rates. Yes or no? The cross rate, I'll check with the actual rate that is quoted. Are you following or not? If they are different, there exists an arbitrage. This arbitrage, I call as what arbitrage? Currency arbitrage. Everybody respond, are you following or not? Now, for example, I'll say for example, I can find out rupees to pound. I can find out what? Rupees to pound. With what as a common currency? Dollar as a common currency. A cross rate. I don't know. This cross rate, I'll compare with the actual rate of what? Pound to rupees, which is there in what? The London market. If the prices are different, one can make an arbitrage profit. Right or not? Yes or no? No. Can you start with the solution? Now, see. Participate. Comparing actual rate and cross rates. Tell me, cross rate. Rupees to pound is equal to what into what? Rupees to dollar into dollar by pound. Right or not? Look at the workbook and tell me what is $1 is equal to how much rupees? Tell me. How much rupees is going to be? 35.625. 1 pound is equal to how many dollars? 1.5820. This is all the exchange rate available actually quoted in the market. Right or not? Based on this, if I multiply, I should be saying that 1 pound should be how much rupees? 56.35875 rupees. Everybody, are you following or not? The cross rate says, the reason is very simple. If $1 is equal to 35.625 rupees and 1 pound is equal to what? $1.5820, the exchange rate between the pound and what? Rupees should have been how much? 56.35875. Am I right or not? But if you look at the international market, there the pound is quoted for how much rupees here? It is 55.50. Tell me the actual rate quoted is right or wrong? It is what? Wrong. It is not satisfying the cross rates. Are you following? Because three currencies value should be mutually adjusting against each other. Yes or no? In other words, a currency may be undervalued or overvalued in the actual market. Everybody following or not? Now, answer my question. I have given the quotation for rupees or pounds. Always for what you write the quotation, that only you should say whether it is undervalued or overvalued. Now tell me, what is given price? Price is given for rupees or pounds or pounds. The pound price should have been how much? 56.35875. But is now how much? 45.50. Is a pound in the real market overpriced, underpriced? When something is underpriced, you will sell it or buy it? So now I have to buy the pound. I have to what? Buy the pound. Strategy, when I have to what? Buy the pound. Can I start or not? No. See here. I take from my pocket rupees. I take from my pocket what? Rupees. To buy what? Pound. Can I start doing the sum or not? Now, please participate. Strategy, invest 100 rupees in what? Exchange market. I take 100 rupees, put into the currency market. Can I start or not? Now, with that 100 rupees first, I am going to buy dollar or pound? Pound. Now, pound is under price against rupee or not? I put 100 rupees and buy what? Pound. Please take the calculator and tell me, actually, 1 pound, I just write here, 1 pound is equal to how much rupees? Actual rate? 55.5000. Okay. Now, how many rupees I am having? 100 rupees. With this, I should be able to purchase some number of pounds or not? Tell me. I put 100 rupees in the market and buy how many pounds? Tell me how many pounds? 1.8018. 1.8018. So many pounds I can purchase by putting 100 rupees in the exchange market. Everybody, yes or no? Now, let us continue further. Sell Indian rupees and buy what? Pounds. How many pounds I'll be getting? 100 by 55.5. As you said, I get pound selling 1.8018. Right or not? Now, in my hand, I'm having no what? Pound. I just travel to which country next? New York. Then I'm going to convert the pound into what? Rupees. That is pound into dollars. Tell me the exchange rate. 1 pound is equal to how many dollars? 1 point? Okay. That means 1.8018 pounds should be giving me 1.8018 into what? 1.5820. How many dollars? $2.8505. Right or not? Now, in my hand, what I'm having? Dollar. I bring the dollar into what? India. And convert it into rupees. Tell me $1 is equal to how much rupees in India? If how much you want to 35.65. $2.8505 gives me how much? 101.54. So now I'm having how much profit? 1 point, because 100 put into the market, I got back what? 1.54. Very simple. I took 100 and traveled to London. I traveled to what? London. In that I got how much pound? 1.8018. I took that pound and went to which market? New York. And converted into what? Dollars. How many dollars? 2.8505. I took the dollar and came back to what? Delhi and converted into rupees. I got how much rupees here? 101.54. After traveling 3 countries, I got how much rupees? 1 rupee 54 paise. Respond yes or no. Then we call as what? Currency arbitrage. We need not travel through 3 countries. Sitting in the home, the buy and sell order can be what? Given through online, and this profit can be made if a person is able to identify the mispricing between the currencies. Everybody following an order. This is what we call as what arbitrage? Currency arbitrage. Respond yes or no. Clarity now. So please copy the solution. Step 1, comparing actual rate and cross rates. Please. Finish copying, huh? Finish number. Shall I proceed? Write down. As per the cross rate, the pound is really worth. As per the cross rate, a pound is really worth. A pound is really worth rupees 56.35875. A pound is really worth rupees 56.35875. But it trades at how much rupees? 55.50 rupees. But it trades at rupees 55.50. Hence the pound is, fill in the blanks, under or overpriced? Underpriced. Hence the pound is underpriced. Therefore recommended to buy it or sell it? Buy it. Therefore recommended to buy it. Shall I proceed or not? Now, that 100 rupees is my assumed number. It is only an assume. You can even assume 1000 or 1 lakh as the case may be. Can I proceed up? Now. Invest rupees 100 in the exchange market. Don't ask me what is that interest happening. All the things happens in one single day or even in 1 minute. Yes or no? Because I just buy and sell immediately at spot rates. There's no role for a interest rate coming here because I am not doing it across time. I am doing everything in what? Simultaneously today itself. Are you following? Invest rupees 100 in the exchange market. Copy this slide quickly. Finish copying on. Stop talking, please. Can I proceed? Those not copy, raise your hand. Okay. Take question number 45. Take question number 45, a miscellaneous problem. Again, an examination sum has been asked 2 or 3 times in the exams, also that in the RTP. Okay, take question number 45. On December 27, please. No new concepts will be discussing. All are here, miscellaneous bits and pieces. Some we are just winding up the chapter. That's all. Can I proceed now? Question number 27. Question number 45. Sorry. On December 27, A customer requested a bank to remit DG, okay, it is DG, Jewish Guild, 2,50,000 to Holland in payment for import of diamonds under an irrevocable letter of credit. However, due to bank strike, the bank could effect the remittance only on January 3. The market rates were as follows. In Bombay, can you read the quotation for me? In Bombay, how to read it? 100 rupees is equal to $3.10 and $3.15. And on January 3, they given you the other way. In London, read the quotation, 1 pound is equal to 1.7250, $1.7260. Same way they given for January 3. And then DG to pound, Jewish Guild to pound. So how to read it here? 1 pound is equal to 3.9575 Jewish Guild. It is what? Bid rate. And 3.9590 offer rate. The bank wishes to retain an exchange margin of 0.125%. How much does the customer stand to gain or lose due to the delay? Can I proceed or not? Now. Okay, see. You are going to buy from the bank or sell to the bank, Jewish Guild. We are going to buy from the bank, Jewish Guild. How much should we buy? 2,50,000. DG should be bought, right or not? Okay, now. You ask the bank to remit. That is, you ask the bank to straight away remit that money to what? Your supplier in Holland, right or not? So you ask the bank to remit that money to the supplier on which day? December 27. That is, the bank should have done the transaction on what? December 27 at that particular day's rate, right or not? But what happened is, on December 27, suddenly, what happened? Strike took place. So the bank can do this transaction only on what? January. Because strike take place, the New Year holiday will be there, everything over. The bank resume the work only on what? January 3. Now the question is, will the bank do the transaction at December 27 rate, January 3 rate? It will be on a what rate? January 3 only. For strike and all, you cannot claim compensation on what bank. Till now, like that, laws are not there in our country, right or not? Strike is a right, right? A right to strike, right or not? So protesting is what? A right only. So due to strike, so many things are happening. People lose their life due to last day. What? Want of transport facility. Anything may happen. You cannot ask anybody anything, right or not? So strike is an act of God, right? It's an act of what? God. So bank did not do on December 27. That is only on what? January 3. On the January 3, you may be made to pay more or made to pay what? Less. The strike may work to your advantage or against what? So it can be your disadvantage also. In that case, the question is, what is the gain or loss made by this company due to the delay in the payment? Is a question. Everybody understanding the question or not? It's a very simple question. But here we have to calculate what rate? Cross rates. The main thing which why we are doing is to calculate cross rates. I have two common currencies. Name the two common currencies. Dollar and pound are the two common currencies. Using two common currencies, I should be calculating what? Cross rate. Once we know how to write the equation, then we can just do the problem together. Can we start or not? Now, see, I want an exchange rate between what and what currency? Tell me. Rupees and DG. Please, all of you participate. I want an exchange rate between rupees and what? DG. Now tell me the cross rates. Against rupee, what is given in the question? What is the question here? Dollar. Can tell me the exchange rate? Rupees to dollar. And then next is what? Into dollar by pound. Into what? Pound by DG. Will give you the cross rate. Yes or no? Rupees to dollar into dollar by pound into pound by DG. Understood? If you don't know how to write it, very simple. Yeah. What happens is, I want rupees and DG cross rate or not? No. Rupee should be in the top or not? So what I write is, I first write rupee should be in top. For that, what currency against given? Dollar. Write it, leave it, okay, into, leave some gap. I should have DG in the bottom or not? For against DG, what currency given? Pound. I write pound in top. Okay. Now I have rupees to dollar. I want what? Pound to DG. But in between, what should happen here? Dollar and pound should be getting cancelled or not? This bottom goes to what? Top. And this top comes to what? Bottom. That gives you the cross rate. This point, are you following or not? Now, this point number 1. Can you proceed? Now, next question is, rupees to DG, I want bid rate or offer rate? Good morning, friends, all of you. Rupees offer rate. Why? Because I am buying foreign currency. I buy foreign currency at my bankers offer rate. So what I want is, I want a cross offer rate. I want a cross what? Offer rate. So everything should be offer rate. Yes or no? Now tell me, have they given rupees to dollar, dollar to rupees? Tell me. In the question, have they given quotation for rupees or dollars? They are given for what? Rupees. 100 rupees is equal to so many dollars. They give a quotation for what? Rupees. I want a quotation for what? Dollar. That means I should find out the other way code. Yes or no? When I want offer rate, what I should do? I should go for what? 1 by bid rate. In this particular case, respond yes or no? I will not write 1 by. I will write what? 100 by, because the currency is given in hundreds of units. Respond yes or no? Can I proceed further? Now, next is dollar by pound. Okay, that is, I want 1 pound is equal to how many dollars? Is it given or not? Yes, it is straight away given. So I will straight away use what rate? Offer rate to be used. Innappa, respond yes or no? Now, third case, I want the quotation for DG. Have they given quotation for DG in the question? Quotation for pound in the question? Quotation for pound. I want quotation for DG. I should find out what? Other way code. When I want offer, I have to write what? 1 by bid rate. This should be kept in mind before you start writing the solution. Yes or no? So, for rupees to dollar, I write what? 1 by bid rate. For next is what? Offer rate. And third is 1 by bid rate. If I multiply, I will be getting the cross rate for what? Rupees to DG. This I should calculate 2 times. First for what? 27th December, and next is for what? January 3rd, and compare to say whether I am going to make a gain or loss, and add exchange margin and then go for the balance. Everybody respond. Are you following or not? I have not started doing the solution. I only told you how to go about it. Can you start doing the solution together or not? No. Those understood my discussion till now, raise your hand. Okay, can I proceed? Let's start with the solution, please. Okay, right, question number, I think it's question number 45. Question number 45. If you want, you can just give a name for this sum. It may be cross rates using, give the heading, cross rate using, how many common currencies? Two common currencies. There are 4 currencies. In which 2 currencies are going to be having the rates. So cross rates between 2 common currencies. Cross rates between using 2 common currencies. Cross rates using 2 common currencies. Okay. Can we start or not? Now, let's write one by one. Exposure. Exposure. Fill in the blanks. How much DG? 2,50,000 DG. Receivable or payable? Payable. 2,50,000 DG payable. I should purchase and settle it. Payable. INR to DG. I am writing the equation for cross rates. INR to DG. Formula. INR to DG is equal to what into what into what? Tell me. INR to dollar into dollar to pound into pound to DG. INR to dollar into dollar to pound into pound to DG. INR to dollar, dollar to pound and pound to DG. Applicable rate. I want INR to DG. Bid rate or offer rate? Offer rate. You know, I buy at bankers, offer rate. Applicable rate is offer rate. Applicable rate is offer rate. Now payables nale offer rate. Can I proceed or not? No. Can I proceed? INR to DG December 27. INR to DG December 27. Here only I will not tell. You should tell, then only I will put the slide. Tell me. INR to dollar. Tell me how to calculate INR dollar. Have they given INR to dollar or dollar to INR? I have to find out the other way. If I want an offer, what I should do? 1 by bid rate. Is it 1 by or 100 by? 100 by. Tell me first what? December 27, no, 100 by 3.1. Exactly 100 by 3.1 into, please don't write, first tell and then write 100 by 3.1 into, I want dollar by pound. Have they given dollar by pound or not? Yes. Straight what is dollar by pound offer rate? 1.7260 into, I want pound to DG. But they given you what? DG to pound. So once again what? 1 by bid rate. It is 1 by 3.9575. This gives you this particular number. Copy this. 100 by 3.1 into 100 by 3.1 into 1.7260 into 1 by 3.9575 into 1 by 3.9575. Don't look at the logic of the rate. Examination sum. Can I proceed? 1 by 3.9575 is equal to 14.0688. 14.0688. 14.0688. Can I go to the next rate or not? No. Same way, you have to tell me the calculation for what? January 3. INR to DG, January 3. INR to DG, January 3. Now, at least you tell full number and then write what by what into what into what by what. Tell me. 100 by, everybody 100 by 3.07 into 1.7185 into 1 by 3.9380 into 1 by 3.9380. 100 by 3.07 into 1.7185 into 1 by 3.9380 is equal to 14.2146. 14.2146. Everybody comfortable or not? Now, had the strike not taken place, listen and I explain. Had the strike not taken place, I would have bought my Jewish guild at how much rupees? 14.0688. Due to strike, I have to pay how much? 14.2146. I will curse the employees, bless them. Why will curse here? Because I have to pay more due to no fault of mine. Yes or no? I have to pay what? Money more. Can I proceed? Now, continue writing. Gain or loss. Underline that. Gain or loss. Underline that. INR to DG, December 27. INR to DG, December 27. 14.0688. 14.0688. INR to DG, January 3. INR to DG, January 3. 14.2146. 14.2146. Tell me gain or loss? Difference, loss. For every DG which I purchase, how much I pay more? The loss is 0.1458. The loss is 0.1458. That is, I am made to pay 14 paise approximately extra for every DG I purchase. So no, like that I purchase how many DGs? 2,50,000. The total loss is 2,50,000 into 0.1458. 2,50,000 into 0.1458 is equal to how much rupees? 36,450. 2,50,000 into 0.1458, 36,450. 36,450. Now, another shock for me. In this loss, I have to pay some extra exchange margin or not? Earlier, the exchange margin would have been on what amount? 14.0688. Now they charge the exchange margin on what? 14.2146. I not only have to pay 14 paise extra, I have to pay what? 0.125% extra on what? This 14 paise, yes or no? So rubbing salt into the wound, exchange margin is 0.125%. Exchange margin is 0.125%. How much the extra exchange margin I have to pay? Extra payment into that margin percentage is going to be 46 rupees. 36,450 into 0.125% is 46 rupees. 36,000 into 36,450 into 0.125% is equal to 46 rupees. Now, the loss is going to be how much here? 36,450 plus 46. 36,450 plus 46 gives you 36,496. The loss is 36,496. 36,496. Respond. Everybody following or not? No. In the sum, only thing what we learned is what? Cross trace calculation using two common currency quotations. That's all. Okay. Now, question number 46. I give it as homework. It is similar to question number 45. But 45 is for payable and 46 is for receivable. That it is DG, it is going to be Singapore dollar. The currency and the number changes, but the way in which we should be doing is going to be absolutely same. So I give the question number 46 as a homework problem. Can we proceed or not? No. Shall I proceed? No. Answer, just a minute. Please. We'll just have a check of the numbers typed and I'll give you the answer. It should tally enough. Now. Check the 45 point. Make it as 84. I had as 89 given in the question or not? No. Please make it as 45.84. INR to dollar. Question number 46. INR to dollar. Make it as 45.84. Make it as 45.84 and then 45.90. Other rates I think are exactly correct. Right or not? No. Am I correct? Huh? And that you leave, dates you leave is not an issue now. The answer is 2,23,221 rupees. What is the answer? 2,23,221 rupees. Here I will be blessing the banker. I am going to make a gain. Due to strike, I am going to make a gain. 2,23,221 rupees. 223,221 rupees. You can try the answer later. Okay. Now. Take question number 47. Please. Don't talk. Take question number 47. In March, please. In March, an MNC makes the following assessment of dollar rates for Great Britain pound to prevail as on September. So it is 1.6, 1.7, 1.8, 1.9 and 2. 1 GBP is equal to so many dollars is given. Probability of these rates also has been given in the question. What is the expected spot rate for September? If the March 6 months forward rate is $1.80, should the firm sell forward at GBP receivable due in September? That's a question. Can we start or not? Now, see. Exchange rate forecasting is also one of the area people specialize. Okay. What will be the exchange rate after 6 months? People will try to forecast because exchange is a function of various demand and supply, interest rate, economic performance of countries, etc., etc. Right or not? And globally, most of the business will be having cycles which are sometimes predictable. Okay. It may be oil production, maybe water, predictable in cycles. Similarly, the business cycle, the government's economic policy, which direction they are going, whether they are going for infrastructure or going for more, say, liberalization, everything, they know about the government policies, various government attitudes and so on. So, people are there who guess exchange rates after a particular period based on which they advise their clients. Are you following? Now, in that case, what happened is, today is what date? Today is what year? March. I am forecasting for what date? September. Somebody asked, what is the exchange rate between pound and dollar in what? September. What may be the exchange rate between pound and dollar in September? The answer was given as follows. A pound may range between $1.6 to how many dollars? $2. Yes or no? They say a pound may range between $1.6 to $2. For a pound to be $1.6, there is a chance of 15%, 0.15 probability. When you forecast something, you attach a certainty to your forecast. Written order, you say there's a 15% chance of it being what? 1.60. And there is a 20% chance of being what? 1.70. Like that, they given you for different exchange, that is exchange rates for the pound. They given you the probability. Every probability may be linked to a particular economic scenario. So if this happens, this may be the exchange rate. If this happens, this may be the exchange rate. For the events, there can be a probability, right or not? Like that, they given you the exchange rate forecasting with the probabilities for different exchange rate. Everybody, right or not? Now answer my question. After 6 months, now it is March, no? In September, I am expecting a pound to be between what and what dollars? $1.6 and $2. It may be 1.6 or 1.7 or 1.8 or 1.9 or 2. For every contingency, they given you what? The probability also attached to it, right or not? Now, tell me. Today we have to expect an exchange rate. Yes or no? You have the data now. You have to what? Expect an exchange rate. Tell me, will you expect the exchange rate to be $1.6 or $2? You expect an exchange rate of pound to be $1.6 or $2? 1.6 or $2? I don't expect extremes. I expect average. I don't expect extremes. I always expect what? Average. From now onwards, know that the word expected means what? Average. Because average is the most superior statistical data. Written order. So the mean is the king of what? Statistics, where we don't expect extremes. We always expect only what? Average. Now I expect average. So average is 1.6 plus 1.7 plus 1.8 plus 1.9 plus 2 whole divided by 5 is the average. True or false? Now sollupa, yes or no? Now right here, you write 5 subjects. You write how many subjects? 4 subjects. For example, one group. Okay. So you add, what is the average mark? What you will do? You add all the 4 subjects mark divided by what? 4. Sigma x by n average. So no, I add 1.6, 1.7, 1.8, 1.9, 2. Everything divided by what? 5 gives me the average rate. That average is called as simple average. It's called as what? Simple average as well. Every number has got equal chance. Are you following? But if the number is having equal chance, different chances are different chance. I should give more weight to 1.8 and less weight to what? 1.7, because it is having 25% probability. It is having only what? 15%. So I should not go for simple average. I should go for what average? Weighted average. So the word expected means what? Average. If the numbers are having assigned a probability, the average becomes what average? Weighted average. We'll use this number very frequently in portfolio theories later. Everybody following or not? So now tell me, what is weighted average formula? W1x1 plus W2x2 plus W3x3 plus W4x4 plus W5x5 whole divided by what? W1 plus W2 plus W3 plus W4 plus W5. Enna right or not? Now, x1, x2, x3, x4, x5 the data is called as what? Dollar. And the weights are there what? Probabilities. Multiply probability by what? The numbers and divided by the total of probability. All probability should total to what? 1. Correct? Can a probability be 1.1? Can be 0.9? We can say in what? I'm 110% sure, but that is also what? 100% only, right or not? So probability can either say, can be exactly 1. The total should be exactly 1. So this is going to be the calculation. Ennappa, right or not? Now, please, let me complete it. Question number, don't get worried. It is rearranged. Okay. Now, what the probability? 0.15. What the rate? 1.6. It is W1, X1, 0.15 into 1.6, this number. At least tell me another 2 or 3 rows to know you are awake. Yeah, tell me next is what? 0.20. What the rate? 1.7. The weighted rate is 0.34. Next is 0.25, 1.8, 0.45, 0.20, 1.9, 0.38. 0.20, 2 it is 0.40. If I total, the exponent is going to be 1.81. W1x1 plus W2x2 plus W3x3 plus W4x4 plus W5x5 whole divided by the total of probability is what? 1. Gives a 1.81 plus 1. Yes or no? So what I say is, I expect. What I expect? I expect the dollar to the pound to be how many dollars? $1.81. After how many months? 6 months. This is my exchange rate forecasting, right or not? Can I proceed or not? No. I'll complete the sum and then give you time to copy it. Now, read the question. Now, you want to sell the pound. You want to what? Sell the pound. See the second question. First question is, what is the expected spot rate? What is the expected spot rate? 1.81. Next. Suppose today a forward rate is available. What is forward rate available? 1.80. Respond. Forward available 1.80. Should the firm sell forward its pound receivable due in September? That's a question. Can I proceed? Now, I have an option. Either I can cover myself today itself by going for a forward sell at 1.8. Is or no? Yes, or I can keep it open where I expect it to become how much? 1.81 after 6 months. Tell me which is better. Keep the exposure uncovered. Cover using forward hedging. Everybody, are you following what I am saying? This is always a call a company has to take, because always hedging may not be good, because hedging creates certainty, but sometimes it creates certainty with undue cost. Are you following what I am saying? In that case, 1.8 is a forward cover available, but I expect it to be how much? 1.81 after what? 6 months. Tell me I should go for forward cover or wait till 6 months? Prima facie, it may seem to be what? Wait till 6 months. Everybody following or not? No. No. I have not completed my discussion. Understand the points one by one. Okay. Now, I have got two choices. What are two choices? Today itself sell. Today itself what? Sell pound in the forward market at how many dollars? 1.8. In that case, whatever happens after what? 6 months, I'll be getting $1.8 per pound. Yes or no? The second option is, I need not do anything. I can leave my exposure what? Unhedged or uncovered and wait for the exchange rate to happen at the 1st September. And here I expect today that based on my forecasting, it may be how much on an average? 1.81. Now answer my question. Should I go for forward cover at 1.8 or leave it unhedged on 1.81? Okay. If you see the number alone, I can leave it what? Unhedged for 1.81 because it's going to be 0.01 extra. It is not. But the question is, for that extra, how much risk I am taking is important or not? How much I am going to take is going to be what? Very, very important. Now, I can analyze this way. Forward is 1.8, right or not? There is, for example, 15 plus 20, 35. Plus 20, how much? 40 divided by 60. There's a 60% chance that the exchange rate will be 1.8 or less. But there's only a 40% chance for the exchange rate to be what? More than 1.8. Now, to beat my forward, to what? Beat my forward cover, I have how much chance? 40% chance. If you look that way, I can say that I need not say wait for tomorrow. For that 40% chance, I can just rather go today itself with that 60%. Respond, or will follow not. This is the way the conservative person will be what? Thinking. Other person thinks like that. Anyhow, leave 1.8. There is how much chance? 35% chance of receiving less than what? 1.8. There is how much chance? 65% chance of receiving what? 1.8 or more. In that case, even if it comes at 1.8, I am not unhappy because I am equal to what? Forward. So let me take the risk. Also, a risk can be taken. Yes or no? In a question, in that case, both ways it can be argued. It all depends on the instinct of the person who wants to take a call regarding whether he should go for the forward or go for the exchange rate forecasting. Can I proceed or not? Now. So please copy the solution quickly. Write down first. Expected exchange rate after 6 months. Expected exchange rate after 6 months. Finish coming on. Finish copying, huh? Can I proceed, huh? Those who are not copy, raise your hand. Fast. Okay. Point number one. Point number one. We do not expect extremes. We do not expect extremes. We do not expect extremes, but average. We do not expect extremes, but average. Full stop. Continue. When probabilities are given, the average means. When probabilities are given, the average means what average? Weighted average. When probabilities are given, average means weighted average. Average means weighted average. Where the weights are probabilities. When probabilities are given, average means weighted average. Where the weights are probabilities. Where the weights are probabilities. Where the weights are probabilities. Everybody following or not? Next. Point number 2. We have a forward cover giving us. We have a forward cover giving us a certain $1.8 per pound. We have a forward cover giving us a certain $1.8 per pound. We have a forward cover giving us a certain $1.8 per pound. While if we leave the exposure unhedged, we expect to receive, we expect to receive how many dollars? $1.81 per pound. We expect to receive $1.81 per pound. Point number 2 or 3 or 3. Thus, leaving exposure uncovered, will give an extra realization. Thus, leaving exposure uncovered will give an extra realization of what? $0.01 per pound. Will give extra realization of $0.01 per pound, but with a how much percent risk? 35% risk, but with a 35% risk, because it can even be 1.6 or what? 1.7. 1.8 and above, I don't worry about that, yes or no? But with a 35% risk of not getting but with a 35% risk of not getting that $1.8. But with a 35% risk of not getting $1.8. But with a 35% risk of not getting $1.8. Everybody, are you following or not? Can I proceed? Whether, continue, whether exposure should be covered or uncovered, whether exposure should be covered or uncovered depends on, whether exposure should be covered or uncovered depends on the willingness of the person to take risk. Whether exposure should be covered or uncovered depends on the willingness of the person to take risk. Depends on the willingness of the person to take risk. Depends on the willingness of the person to take risk. Some people say 35% not an issue, I'll take the risk. Some say 35% I won't take the risk. It all depends on the person's perception for going for the cover or not going for the cover. This is a solution to question number 47. Okay, now 48, I'll give it as homework. The solution has been printed and given in the workbook itself. I will 48 as homework. 46 also I gave us homework because it is something very similar to 45. In which one small change I made in question. Exchange rate for December 27 is what? 45.84. Some number. Okay. And take question number 12. Take question number 12. Take question number. What should I do? Switch on AC or switch off? AC or 10 minutes. Take question number 12. Please don't talk. Okay. The following table shows interest rates for US dollar and French francs. Spot exchange rate is 7.05 French franc per dollar. What is the foreign currency? Is the direct code. What is the foreign currency? Dollar. What is the home currency? French franc. Complete the missing figures. All the percentage are annualized. Even if they don't say so, we should know the percentages are what? Annualized. Okay. 3 months, 6 months, 12 months. 3 sets of data are given. 3 months, the dollar interest rate in US is 11.5%, interest rate in France is 19.5%. They ask you to find out the forward as well as the premium or discount percentage. Can I proceed or not? Now, 6 months later, they given you the dollar interest rate. We have to find out the franc interest rate. We have to find out the forward rate, and they given you the premium percentage is how much percent? 6.72%. 12 months they given you the franc interest rate, they given you the forward rate. You have to find out the dollar rate as well as the premium or discount percentage. This is all the question which has been given. It is an IRPT problem. What problem? IRPT problem, where we have to use 2 issues. One is forward determination. How to calculate forward rate? Compound the spot rate using interest rate of 2 currencies to given date. I can arrive at the forward rate. Issue number 1. Over and on. Next is another formula is how to find out forward premium or discount percentage. Forward rate minus spot rate divided by spot rate into 12 by n into 100. These two we are going to use to find out the missing figures. Whatever required should be found out. These two formulas will be used. Everybody, I have the clarity or not? Now, what I will do is, I will do for 3 months, I will do for what? 6 months. I will leave us homework for what? 12 months. Because 6 months and 12 months are almost similar. Only thing is, in 6 months, I have the US interest rate. I have to find out what? France interest rate. In 12 months, I have what? A France interest rate. I have to find out the US interest rate. And the premium discount is very simple. Can I proceed? So, I will do for 3 and 6 months the 4 missing number calculation. And leave us homework for what? 12 months. You know, agreed? Same type of sum has been given in the practice problem segment also is one of the RTP sums, and this is one of the examination problem. Can we start or not? Now let's start with the solution. Nothing rate, applying interest rate parity, and then what? Forward premium discount formula. Can we start or not? Now we will do it together because copying time is very abnormal. It's going to be abnormal loss, right or not? So we'll be doing it together. Can we start with the solution or not? Now, first, 3 months forward rate. Right on step 1, 3 months forward rate. Question number 12, 3 months forward rate. All of you participate in the discussion. 3 months forward rate. Formula. What the formula? Spot rate is equal to, first write the spot rate is equal to what? Is equal to what? $1 is equal to 7.05 FFR. Spot rate, $1 is equal to 7.05 French francs. $1 is equal to 7.05 French franc. Are you all writing along with me? Now, I should compound both using the country's interest rates or not? Now, applying IRPT, interest rate parity theorem, applying IRPT, 3 months forward is as follows. Applying IRPT 3 months forward is as follows. Applying IRPT 3 months forward is as follows. Okay. Now, before I proceed, what is a dollar interest rate? What interest rate here? 11.5% is for how many years? 1 year. I am going to compound for 1 or 3 months. So 11.5% divided by 4. Tell me what is 11.5% divided by 4? I want a number. 2.875. That means a dollar should be compounded at 1.02875. Respond. Yes or no? Yes or no? Now, come to the French franc. For the franc interest rate, 19.5 for 1 year. What is for 3 months here? 19.5 divided by 4. What is the number? How many is here? 4.875. Franc should be compounded at 1.04875. Dollar at 1.02875. And franc at what? 1.04875. Yes or no? Now, continue writing. $1 plus. $1 plus, I am writing the interest. What is the interest? $1 into 11.5% into 3 by 12. $1 plus $1 into 11.5% into 3 by 12. $1 into 11.5% into 3 by 12. This is going to be the maturity value. Simply can write as what? $1 into 1.02875. The same number you will be getting is equal to how many French franc? 7.05 French franc. There is a franc interest rate, so franc exchange rate, 7.05 franc plus on this. I earn how much percent interest? 19.5% interest. How many months here? 3 months. 7.05 franc plus 7.05 into 19.5% into 3 by 12. Rearrange. I'll be getting $1.02875 is equal to $1.02875 is equal to FFR 7.3937. $1.02875 is equal to FFR 7.3937. Respond yes or no? Tell me how I can get FFR 7937. Another way is what? 7.05 into 1.04875 also gives you what? Same number. Rearrange. $1 is equal to FFR 7.1871. $1 is equal to FFR 7.1871. How I got the number in bracket, right? 7.3937 divided by 7.3937 divided by 1.02875. 7.3937 divided by 1.02875 divided by 1.02875. Respond. Are you following or not? With this, we completed question mark number 1. Namely what? Forward franc per dollar. Now, what is a forward rate? What is a forward rate? $1 is equal to how many French franc? 7.1871. What is the spot rate? 7.05. Might tell me, is the dollar appreciating or depreciating? Always tell for the currency given the quotation, dollar appreciating or depreciating? Appreciating. Dollar is quoting a premium or discount? Premium. This premium should be expressed in annualized percentage or not? Yes. Let's go for the next calculation. Before that, tell me, why dollar is quoting a premium? Because interest rate in US is what? Less. So the currency should be obviously strong. Can I proceed? Next. Step 2. 3 months forward premium annualized percentage. Step 2. 3 months forward premium annualized percentage. 3 months forward premium annualized percentage. 3 months forward premium annualized percentage. Okay. Formula. What is the formula? Forward premium percentage is equal to forward premium percentage is equal to forward rate minus spot rate divided by spot rate. Forward rate minus spot rate divided by spot rate into 12 by n into 100. Forward rate minus spot rate divided by spot rate into 12 by n into 100. Let's substitute the numbers. What the forward rate I am having? 7.1871. Number right or not? 7.1871 minus 7.05. 7.1871 minus 7.05 divided by 7.05 divided by 7.05 into 12 by 3. 3 ones forward na into 12 by 3 into 100 into 12 by 3 into 100. Tell me the number. What the number you going to get? It is 7.78%. 7.78%. 7.78%. Shall I proceed to the next part or not? Now, 3 months 2 question marks have been filled up. One is what? Forward rate. Another is a forward premium percentage. Can I proceed to 6 months or not? Right now, next. Step 2 or 3? 3. Step 3. Calculation of 6 months forward rate. Calculation of 6 months forward rate. Calculation of 6 months forward rate. We are going to do the next block in the problem, the second column, okay? Calculation of 6 months forward rate. Stop and answer me. Can I calculate 6 months forward rate now using IRPT? Now, yes or no? Why you say it is no? Because I have only dollar interest rate. I don't have the franc interest rate to compound. I cannot use the IRPT to calculate that calculation, right or not? Now, how to find out forward rate? Very simple. I know spot rate. I know spot rate. I know number of months. I know premium. I also know what a premium percentage. What a premium percentage? 6.72. Known the premium percentage, spot rate and N. Can't I find a forward rate using that particular formula or not? Can I proceed further? Write down. Next. Forward premium is equal to forward premium is equal to forward rate minus spot rate divided by spot rate. Forward premium is equal to forward rate minus spot rate divided by spot rate into 12 by n into 100. Forward rate minus spot rate by spot rate into 12 by n into 100. Now, tell me, what a premium percentage given? 6.72% is equal to 6.72 simply write, don't write percentage because 100 is not that side. Yes or no? 6.72 is equal to 6.72 is equal to forward rate. I have to find out forward rate minus for the spot rate for the franc 7.05. Forward rate minus 7.05. Forward rate minus 7.05 divided by what? 7.05. Forward rate minus 1.05 divided by 7.05 into 12 by how many months forward? 6 months into 12 by 6 into 100 into 12 by 6 into 100. 12 by 6 into 100. If I just simplify it, I'll be getting forward rate as that. You can just try on your own. It is very simple. Rearrange the numbers. I'll get forward rate as 7.2869. I'll get forward rate as 7.2869. I don't want to waste time in the rearrangement and calculation. Believe me, what is the forward rate? 7.2869. Forward is 7.2869. Please respond. This is how many months forward here? 6 months forward. That is obviously understood, right or not? Now, tell me. First, have you finished writing? Look up and tell me. I have spot rate. What is spot rate? $1 is equal to $1 is equal to 7.05 FFR. Do I have forward rate? Yes. $1 is equal to 7.2869. I have spot rate. Now I have forward rate. I have interest rate of one country. Right? Correct? Then can't I find out the interest rate of the other country or not? No. It is implied in the interest rate parity. I assume the forward is as per the IRPT. Everybody following or not? So given the two forward rates and interest rate of one country, I now try to find out the interest rate of the another country. Can I proceed further or not? Next. Step number 2 or 3 or 4? 4. The last step, because the remaining 2 I leave it as homework. Okay. Step number 4. Franc interest rate. Franc interest rate. Franc interest rate. Okay. Write the spot first. What is the spot rate? $1 is equal to 7.05 FFR. Spot rate $1 is equal to 7.05 FFR. 7.05 FFR. Are you understanding writing or not? Now, let us compound. Now, just a minute. Dollar gets compounded for how many months? 6 months. At what percent interest rate? 12.25% interest rate. The 7.05 franc gets compounded for how many months? 6 months. At what percent interest rate? At X% interest rate. Everybody, can I proceed or not? Now, so write down. Applying IRPT theorem 6 months. Applying IRPT theorem 6 months. Applying IRPT theorem 6 months. $1 plus, a dollar will not be a dollar, it will become something more than that or not. $1 plus, for the interest on $1, 1 into $1 plus 1 into, how much interest they provide? 12.25% into, how many months here? 6 by 12. That is the $1 principal along with what? This interest will become the maturity after 6 months, right or not? $1 plus $1 into 12.25% into 6 by 12. In the left hand side is equal to, what happens to French franc? Is equal to 7.05 French franc plus, that's the principal now, 7.05 French franc plus, I earn 7.05 into 7.05 into, on which how much interest I earn? X by 100. I don't know the interest, I have to calculate it now into X by 100. Into how many months? 6 by 12. $1 plus $1 into 12.25% into 6 by 12 is equal to FFR 7.05 plus 7.05 into X by 100 into 6 by 12. Yes or no? And this will be equal to a forward rate we have calculated earlier in the previous slide. Right or not? Now, I'll proceed further. $1 is equal to, I want $1 value, no other than the forward rate. $1 is equal to FFR 7.05 plus $1 is equal to FFR 7.05 plus 7.05 into X by 100 into 6 by 12 is the numerator. What is the right hand side now? Is the numerator. FFR 7.05 plus FR, that is 7.05 into X by 100 into 6 by 12 divided by 1.06125. divided by 1.06, 125. 1.06, 125. Did you understand that 1.06, 125? If you don't understand, look at the left hand side. Look at what? Left hand side. Tell me what is the left hand side first here. $1 plus. This is going to be happening to be how many dollars? $0.06125. Inna ya, right or not? Those who want to explain, raise your hand here. I'll explain 1 second. See. I'll write it. Left hand side. Tell me first. Left hand side. What is left hand side? $1 plus. What is that? $1 into 12.25% into 6 by 12. In the left hand side, no? How to write it? $1 plus. What is this here? 1 into 12.25% and 6 by 12 gives you what? $0.06125. What left hand side? $1.06125 is equal to right hand side. Yes or no? $1 is equal to what? Right hand side divided by what? 1.06125. I can explain beyond this. Can I proceed or not? No. So $1 is equal to so many F of R I'm having. Yes or no? But I know the answer. The answer for this is how much? $1 is how many F of R? 7.2869. So which is equal to that is F of R 7.05 plus F of R 7.05 plus 7.05 into x by 100 into 6 by 12. F of R 7.05 plus 7.05 into x by 100 into 6 by 12 divided by 1.06125. Divided by 1.06125. This number I obtain using what theory? IRPT. Is the value of $1 no? It should be equal to how much? 7.2869. It should be equal to 7.2869. We know that $1 is equal to 7.2869. We know that $1 is equal to this particular RHS. So the RHS should be equal to how much? 7.2869. Simplifying it, I'll get X is equal to 19.38%. That simplification you do on your own. X is equal to how much percentage? 19.38%. X is equal to 19.38%. X is equal to 19.38%. Respond. By mark here. Now, yes or no? Yes, those understood this sum calculation, last part, raise your hand. Okay, now, those who not understood, raise your hand. Yes. Those who understood, raise your hand once again. Okay. I don't see all the hands. Those who did not understand, raise your hand. Where the other hands are gone? Yeah. Hand vanished. It is Chennai, not Delhi. Right? No, please. Number of hands should total to the strength of the class. Right? You know, normal Venn diagram I am saying. This is what Venn diagram. So, no intersection here. We are mutually exclusive asking you. It should be A union B. Right or not? In that case, number of hands raised for plus number of hands raised again should be equal to what? The total of the class. Now, how I know? Can I presume I understood? That's all. You go home and try it. So, very simple. I did not do anything great. Now, listen here. $1 7.05 French bank today. Is accepted? All of you. Listen here. Respond. It is a spot rate or forward rate? Spot rate. Now, the dollar grows at what percent? 12.25%. How many months here? 6 months. $1 after 6 months will become $1.06125. This is accepted. The French franc after 6 months will become what? I don't know because the interest rate is what? May say it grows after 6 months to 7.05 plus 7.05 into x by 100 into 6 by 12. Yes or no? That means after 6 months IRPT says that what? The forward rate is 7.05 plus 7.05 into x by 100 into 6 by 12 divided by 1.0625. This entire is equal to right hand side. No, this is IRPT forward as per the IRPT theorem. Yes or no? No. This IRPT forward I equated to what? The form which I calculated using the premium discount 7.2869. I get the interest rate as 19.38. That's all. Everybody following up? Now, same way I give us homework for what? The last two. You can just note down the solution. Note down the solution. 12 months forward premium 6.67%. 12 months forward premium 6.67%. If you want to write in the workbook also again the question mark 6.67%. 6.67%. And dollar interest rate, the 12-month dollar interest rate is 12.5%. The dollar interest rate is 12.5%. Dollar interest rate is 12.5%. Now, we have filled in all the missing figures. Step 1, I found out 7.1871, right or not? Step 2, I found out how much? 7.78. Step 3, 7.2869. Step 4, 19.38. And the remaining 2, I gave it as what? Homework. Is a solution to question number 12 in this chapter. I think you are all following or not? Can I proceed now? No. Okay. Question number 21. Question number 21. I am not going to do the sum. I am going to tell you one small adjustment. Otherwise, it is a straightforward money market X problem only. Can I proceed? Now, see. I will discuss question number 21 concept, one small concept, and then give it as homework. See, money market X payable. Stop talking. Tell me, money market X payable. Tell me the procedure. What money market is payable procedure? Suppose I have a payable of $1 lakh after 1 year. Today what you will do in the dollar market? I'll just what? Deposit. How much you deposit? Present value of 1 lakh. Suppose the interest rate in dollar is 8%. I'll discount at what percent? 8%. Ennappa, right or not? Now. And then next is to deposit. That what I will do? Borrow, convert and deposit. I convert using what rate? Spot offer. Amount borrowed should be repaid along with what? Interest. Suppose India's interest rate is 10%. I compound the borrowing at what percent? 10%. So you discounted the dollar rate of 8%. I compounded interest at how much percent? 10%. I discounted 8% dollar income. I compounded what? 10% rupee expense because I'm a borrower and then what? A payer here. Are you following or not? Now, see. What happens is, if taxation is there in both the countries, if tax is given in what? Both the countries. I'll ask a question. US bank offers me 8% interest. Offers how much interest? 8% interest. Don't say non-resident DTA and all this ignore it. Yeah? I say presume that respective tax rate applies to respective countries. That's all. Okay. In US, 8% deposit interest offered. Right or not? In West, the tax is say 30%. What is tax here? 30%. Our tax is 15%. What is tax here? 15%. Will I receive 8 rupees interest? Less than 8? Less than 8. Because I receive only the interest after paying what? Tax. So 8% into 1 minus tax rate will give you what? After tax interest will be discounted. Right or not? I should not discount at 8%. I should discount at what? 8% into 1 minus 0.15. I should discount at interest after tax. Are you follow what I am saying? Because any interest receivable, I receive not fully 8 rupees. I receive only what? 8 rupees after paying the tax. I into 1 minus t should be the discounted that. Yes or no? Is that correct? No. In India, I pay 10% interest or not? Suppose India's taxation is 30%. What is the taxation here? 30%. I pay 10% interest. Tell me, is my interest expense 10%? I pay 10%, but I also want to say what? Tax on the 10%. So how much I save? 30% tax. The 70% only is what? The net interest payable by me. Yes or no? Because the tax gives you a tax sheet. Yes or no? The interest gives you a tax sheet. So whenever you compound and discount, when a tax is given, you have to compound and discount the interest rate after tax. What is interest rate after tax? Interest rate into 1 minus tax rate gives the interest rate after tax. Everybody, are you following up? Should I repeat that? Can I proceed? Can I proceed or not? No. So again I say, now answer my question. US interest rate is 8%. Simplicity, get tax rate is 20%. Interest how much percent? 8%. Tax rate is how much percent? 20%. Tell me how to discount. How much to discount? 8% into 1 minus 0.2. That gives how much here? 6.4%. Use 6.4% for discounting. India interest rate is 10%. Tax rate is 30%. What to do? It is going to how much percentage? 7%. Component what? 7%. Always I into 1 minus t should be multiplied, and that should be used for discounting or compounding. Is the only point in question number 21. Nothing more than that. Everybody following up? No. Just a small note, right? Note for question 21. Note for question 21. When taxation is given, while discounting or compounding in MMH, when taxation is given, when discounting or compounding in MMH, MMH means what? Money market hedge. When discounting or compounding in money market hedge, we should use what? Interest rate after tax. We should use interest rate after tax. Interest rate after tax is equal to I into 1 minus t. Interest rate after tax is equal to I into 1 minus t. Any number, if I multiply by 1 minus t, I make it as what? After tax. Any after tax number, if I divide it by 1 minus t, I can bring it to what? Before tax. It is always learned in the IPCC or not. So it is I into 1 minus t. That's all. No more extra issue in that particular sum. I'll give you the solution. You can just note it down and then try it. Simply forward hedging, money market hedging is the answer. Can I proceed? Leaving exposure unexposed. There is one more question which I want to multiply by the expected future rate. Now, I'll give the solution for the question number 21. Okay, forward cover, write down answer. Write the answer. Answer, forward cover, dollar outflow 1 lakh. Forward cover, dollar outflow 1 lakh. Another option is future spot. Future spot now do nothing. We just expect it to reach a particular rate. We signed that 1.81, right or not? Expected spot, we got a future spot. You can also say do nothing, also one can use. Okay, future spot, dollar 1,12,500. Future spot, dollar 1,12,500. MMH, 90,534. Money market hedge, 90,534. MMH, 90,534. 90,534. Stop. Tell me, are you following or not? No. With this, we have completed this chapter, International Financial Management. Not today's class, nor the portion. First chapter is over. Can I proceed? No. But an important chapter, a long and big chapter. I don't say it is difficult. The chapter is not difficult, but a very lengthy chapter, and as well as a big chapter. Every exam, around 15 to 20 marks. One can expect from what? IFM. But we have not completed. Only comma has been put. Yes or no? When I say 15 to 20 marks, it also includes what? The derivative portion of the forex also, like currency swaps, options, futures, etc. Which we'll be discussing at that appropriate time later. Now, here, my request is, after 2 months, when I discuss derivatives, and discuss what? Derivatives, I'll come across currency options, futures and all. Right? At that time, in 1 or 2 sums, I'll include this MMH, forward, all the other areas also. At that time, you should not make me teach this once again. Understood or not? No. That means it should be what? Inform, even after what? 2 months. Tomorrow, even a child will tell MMH how to do because now only learn, I don't know. But after 2 months, there's always a memory loss that can take place. How to avoid memory loss? By reinforcing it by revision. Are you following up? Now, so let us go to the next area. Before that, I given you the learning objectives of this chapter in the first page or not. Let us see whether all the learning objectives have been covered by us. Okay. Every chapter I given like this. It gives you a roadmap for what is there in that chapter and there in each and every area. Okay. See. Basics in Forex. We covered or not? Inside that what has been covered? Direct quote, indirect quote, bid rate, offer rate, spread, conversion of direct to indirect, and then cross rates. All the 5 has been discussed in the first part. Number 2 is what? Forward hedging basics. What we discussed there? Forward rate, premium or discount, then what? Outrate versus swap, and percentage premium or discount. Forward rate determination, we discussed 2 theories, namely what? IRPT and purchasing power parity theorem. Covered interest arbitrage, we discussed single code and two-way code. Currency arbitrage, today only we said use cross rates to see currency is underpriced or overpriced, and we did one currency arbitrage problem. Money market rates, receivables and payables, we discussed with single code as well as two-way codes. Single code means bid and offer rate same, deposit and lending rate also same. Two-way code means bid and offer different, deposit and lending interest rate different. Then we discuss about money market rates with domestic and euro rates. When you think about euro rates, one more study should come to your mind. It is called as what? Leading. We also discuss about lagging in 2 sums by using the OD. Next we discuss about netting, how to tackle the timing difference. Then we discuss disposal of forwards. 12 sums we discuss, no, honor and dishonor, preponing or extension. Then dealer's desk problem, we discuss about 2 concepts, exchange position versus cash position and covered deal, and some miscellaneous problem has been covered. This is what has been covered in this chapter, International Financial Management.
Thank you friends. Om Sai Bhojanapalli.